All right, everyone. So today it's going to be just myself doing the presentation, and then Quentin has recorded his presentation. Appreciate everybody coming here to watch. Let's get started with a few charts that I put together. By the way, if you have not had the time yet, and maybe I'm biased to ask you to do so, but we have recently written a letter about our views in particularly the mining space. And if you have not had the chance to read it yet, this presentation is going to be mostly about that and some other fresh views about the markets. But I would love to also say that that's also a recently published piece that we have worked on over the last few weeks. And it's really about how mining comes first. We've been laying the foundation. We've been building a home without really laying the foundation of it. And to me, this is how critically important the mining industry really is to the world and to function the global economy. And these letters are a real intellectual process of trying to not only research as much as possible about a certain subject, but refreshing your views and learning more than anything about this industry more and more. And this time, what I learned is one thing that to me is almost as important as investing in the mining industry. And it's a bit of a doom and gloom sort of view about the world, but it scares me to see how the industry of mining has completely lost its value and relevance in markets. Although when you think about how it is embedded in our society in so many ways that people are not aware of, differently than other industries, we cannot live without mining. And so, to me, it's almost like we're turning from initially when I got involved into investing in mining industries in this mining industry. I first part of that thesis was because of hard assets and how we thought the market from an underlying metal prices standpoint would improve drastically, therefore increasing the margins of these companies and how these companies had an outstanding value proposition to invest. Now, I'm the more I learn about this potential opportunity is that I believe that we're getting into a point where it's now turning from a value proposition to an actual necessity. We have to be spending capital almost in this space to secure metals. Otherwise, things are going to get very dangerous from a society standpoint. The chart that you're looking at the screen is something that I was aware of, but I wanted to measure better and understand what has been the shift in terms of America's dependence on metal imports. We know for a fact that the mining industry, not only globally, but in the US, has diminished to a point that it almost looks like a margin error. And in my view, one of the main aspects of that change has to do with the fact that we've become almost completely reliant on imports of metals. The screen here, as you can see in the chart, is broken down into different types of metals, and it shows all the way to the 1970s to the decade of the 2020s. So it's broken down into decades. How much of those different metals we imported. And as you can see, the numbers in all of them have been increasing. So we've been seeing a gradual increase of metal imports for many reasons. And this includes refined and processing capacity and all sorts of different aspects of the metals and mining industry, of which China has taken over in a huge way in terms of the refining and smelter capacity. But that puts into an important situation of how we're seeing these companies that hold assets in this industry are becoming very strategic for investors at this point. And so if we go to the next chart, you can see in a separate way of a chart that I've used in the past that really caused me to do the research of the prior chart. Really is the fact that the capex of the overall mining industry used to represent close to 17% of nominal GDP. And today we're only 0.3%. And a lot of people that look at this chart, they tend to say that it has to do with efficiency and all sorts of things. And it's not. The reason for it, the more you research about it, is the fact that we're importing more metals. And basically, with just like we have manufactured away our economy, we've had also mine away or this industry to rely on supposedly strategic partners like China that will provide us the metals and that we need. And I think the more you get involved into trying to acquire private companies and other things, what you learn about it is that the Chinese model of capital, and the more you sort of compete with them in terms of investments, you learn that the net present value of most mining companies is completely meaningless to those parties. They approach things from a standpoint of securing metals, and we here in the U.S. and other parts of the world have this tendency of looking at things from a value standpoint, and unfortunately, it's very difficult to compete with parties that are willing to throw almost any level of capital just to acquire something with the thesis of necessity rather than the value proposition, as I said earlier. And it's a lot of these conversations about innovation, about religion, about a lot of times get involved into who comes first, the chicken or the egg. It's sort of that dilemma question that a lot of folks tend to discuss. But this is not one of those dilemmas. Mining has to come first. Otherwise, you can't really build any innovative economy. You can't build robots. All of us would love to have robots adding to the economy. Elon Musk has been talking about potentially adding, the robots to help us more efficiently to live our lives and build things, and also in automation. And but just a simple research on that. If he said we're going to have about even more than what we have in units of cars in the world today. If you just do the back of the envelope calculation on that, you're going to figure out that that alone would consume about 20% it would increase the global electricity demand by about 20%. So these are calculations that are a little bit scary in many fronts. Let's go to the next chart. Now, the next chart it's something that bothered me a bit. So you're looking at the white bars. It's a busy chart. So it's looking at U.S., not global, U.S. electricity consumption per decade. So you're looking at growth on the other hand. So those are growth rates per decade. And that's using an annual growth, average annual growth. And so what you can see here, we've been in a declining growth trend since the 1900s. Now we had the Industrial Revolution, then we had the beginning of 1900s, and later on in 1800s, 1900s, and then you had some moments of electrification that intensified in the early part of the century. Then we had World War I, and after that, the Roaring '20s was a huge part of the electricity consumption at that time. Then we had a big decline, or at least of rates. Right, the rate went from close to approaching 11% all the way down to less than 6%. So it's half of the growth of the prior decade in 1930s because of the Great Depression. And then we had the war in Second World War II in the 40s. And that kind of went on. As you can see this chart, there's so many different, I'm not going to go on to each one of those decades. But recently we've seen the estimates of McKinsey, which has been, why did I use McKinsey? Not because, I endorse them or anything along those lines. It's just because actually they were the most credible institution that had the largest estimates for electricity consumption. And after reading their reports and trying to understand where they're coming from with those estimates, I even think that they're extremely off in their estimates. I would suspect that we may see a 50% growth of electricity consumption in the next 5 years. And I'll share a chart with you in a minute here, so you can have a sense of that. But I try to list all the things that are happening today that are causing this electricity consumption issue. You have the data center expansion. You have electrification in transportation with electrical cars. We have the grid modernization. We're going to be essentially having to do a bunch of changes in infrastructure. We're seeing the industrial revamp aspect, the onshoring trends. We're seeing homes become more electrified. And lastly, we're also seeing the cryptocurrency mining, which, should not be ignored as well. But I suspect that those blue lines are actually being very conservative. I think particularly the 2030s, of course, we're talking estimates. I suspect it's going to be even more of a growth rate than what's presented in this chart. Let's go to the next slide. And the next slide is back of an envelope calculation by a person that was actually shared this chart by Elon Musk. And it's and I thought was, he was basically making a point of how massive, use the word massive, the consumption of power is likely to be just coming from AI alone. And I think there's two important takeaways of this chart. Number one, we're going to be adding an equivalent of the U.S. economy in the next 5 years, looking at this chart, and to the global demand of electricity. Number two, notice China. China would, just has become the manufacturing plant of the global economy. You can notice that the actual data is been in a growth rate that is more accelerated than the U.S. And the main reason for this, in my view, is because of exactly of manufacturing. And if we're going to see onshoring, on that alone, just on those bases, you would expect that the growth rate is going to be drastically higher. I'm very, very afraid that we're about to see a real black swan event in electricity. Electricity shortage is what I'm referring to in the next 3 to 5 years. I think that's one of the biggest unknown risks in the market right now. And if that ever happens, I think it's gonna. Sometimes that's what it takes. It's that type of crisis in society that creates the need and for us to see big changes and human ingenuity to come up with new bold ideas to fix those issues. And I think it's what it's going to take here. And the more conversations we have internally and with investors and friends, and my understanding of this is that consultants, in my view, are very off, and this is why it's a black swan event. If it wasn't, this is why it's likely to be a black swan event. It's because consultants, even really smart people, I'm not trying to say they're not intelligent of where they come from with their views. I think if you read their reports, are missing a lot of very critical aspects of onshoring and artificial intelligence in a huge way, and potentially could be very off in their growth rates. And that's exactly when markets get surprised by a new thing. It's exactly what the issue is. I would break down the opportunity almost in 3 parts from an investment standpoint. You have the energy source. You can have a lot of discussions of what would be used to power the world or the U.S. in the next. Again, a lot of people look at this chart and they say nuclear is the answer. Nuclear is the answer most likely for maybe 10, 15 years from now. We're talking 5 years. If you look at this chart, that's the type of growth we're likely to see. We have to be thinking about this now. What's the commodity that could really, or the energy source that can really help us in the next few years. The things that come to mind are a few things. Solar is the one of the fastest growth energy sources in the U.S. specifically, will likely play a big role into growth and supporting some of those 5 years. But we need something even more reliable than solar. That may be a solution for houses and others, but data centers require way too much electricity to be able to consume solar, for instance. But natural gas is probably your answer. Natural gas is currently about 40% of the energy source for electricity in the U.S. Wouldn't shock me at all if you see an increase maybe from 40 to 60 or something along those lines. So that's one bucket. It's the energy source. The discussions and investments that will be coming from that bucket alone are huge discussions. Number two is the infrastructure. of which I would say that energy is the first bucket I mentioned, is certainly has enough people discussing and thinking about it, and considering different ideas. The nuclear community, the solar community, you have the coal community, you have the natural gas community. All these people are thinking about different ideas on how to approach this issue. Regarding the infrastructure, we're waking up, right? I mean, we're definitely talking about infrastructure more and more. Certainly the grid, the aging of the grid infrastructure in the US is a big discussion. Can we have enough capacity to allow these things to happen? That's where I come from, the view that we're likely to see a black swan event in terms of electricity shortage in the next 3 years or so. But the third, and that's a fascinating discussion too. The third bucket to me is the one that often gets ignored, and that's mining. How do we get the materials to do all these things? How do we get the materials to build the data centers and the homes and the grid and all that? You start looking for consultants, McKinsey and all, S&P Global and all the folks that I respect. By no means I'm trying to be disrespectful to their work, but what you find in their research is that none of them talk about what's going to be required in terms of capital in the next 5 years, even for us to get the mining industry in a better shape. One association of engineers have thrown a number of about $1.5 trillion that needs to be spent in the next 5 years to secure the necessary metals that we're going to need for all this infrastructure. Okay, let's do this calculation for a minute. $1.5 trillion of CapEx over the next 5 years. All right. Well, how much is the overall industry today in terms of market value? Well, it's about $2 trillion. So you're talking that just on CapEx alone, assuming those engineers are correct, which I think, just from experience, I suspect that we're very far from that actual number. It could be double and triple that amount very easily, given how much it costs for us to deploy things, and the fact that we don't have any major development coming into becoming a producing mine anytime soon. Well, those questions are huge, in my view, that's the big elephant in the room that nobody is really talking about. Again, I'm going to repeat a phrase I said at the very beginning. In my view, mining comes first, not last. All right, let's go to the next chart. On the next chart, we're seeing what's happening across the world. We hear all the time trade agreements are improving and not. You have this whole roller coaster of emotions regarding where we are in terms of agreements between US and China and other countries. But one thing has never been told to folks out there is the fact that China has been importing copper and other metals like there's no tomorrow. Yes, we knew that they've been stacking on metals before. We know they've been buying gold and been buying copper. But notice this is the highest number in history that has been reported over the last 2 months. Well, that needs to catch your attention, at least. I mean, it catches my attention. And so clearly, some of these countries are starting to see the need, almost desperately, in what the way it looked like, of importing metals. And copper is in the forefront of that as well. Let's go to the next chart. Now, what I said about the $1.5 trillion and the CapEx required, and you only have $2 trillion of overall market cap for the mining industry, I would say keep in mind the fact that the mining industry as a percentage of global equities is today about 1%. And back in the 60s and 70s used to be about 11%, so 10 times more. I suspect that this is the type of thing that it's a structural problem that, turns into an opportunity. And it's, to me, we cannot be living in a world where, in my view, that we continue to see this declining rate of the relevance of the mining industry relative to global equities and the global economy overall. And if we're going to continue to innovate and grow, very likely we're going to have to be doing this in combination with more capital flows into the mining industry. And so this yellow bar, in my view, is poised to rise. And those are my 2 cents on the macro environment over the next decade or so. Let's go to the next chart. And another thing is how many people, and I think Quinton has made this point before as well. How many people do you know that can put two sentences together about mining? It's very, very, not too long ago, we would talk to prospects and investors, and the biggest question that was asked about mining was, do you think Bitcoin is going to replace gold and all these things? And look, I'm not here to bash on Bitcoin or anything like that, but do people understand the relevance of mining in society at all? And the fact that we're seeing this total change of labor interest in regards to willingness to work in this industry. Are we about, this is a scary world. Like, when we talk about finding experts and people to work and operate mines, that's becoming more and more a very, a very shortage amount of folks that are available to and willing to take that type of work in today's environment. And I suspect that that's going to have to change as well. You can notice here that those long-term trends of the mining labor force it goes through trends as well. Right now we're out of favor, but at some point it comes back. After, and it's usually after. There's no better marketing than making money, unfortunately. And it's usually after the fact. This is the MBA dilemma that Peter Thiel often talks about, and it's usually the new MBA, or I should say the new thing that is popular on universities is usually in a bubble environment. And so you can take that approach to the other side of this, and things that are extremely unpopular are probably, and sometimes mining has been seen as even as uninvestable for many people that say that they are just drunken sailors in terms of spending and deployment of capital decisions that are very poor. And they're not wrong about these issues. Those are real problems from an executive and management standpoint. But again, there is a moment where you stop thinking about value and you start thinking about necessity. And I think we're entering a world where those discussions are starting now. Let's go to the next chart. Now, the next chart is just a way of measuring these things. I mean, a lot of people, like in the technology world and markets nowadays, really like Apple. Apple is about 2 times the entire energy sector in this S&P 500. Now, keep in mind that when you say this to people, they say, well, but Apple makes more money. No, it doesn't. And the energy sector makes the same amount of money that Apple does in free cash flow. And I'll tell you more about this. Apple's revenues have been flat for the last 3 years. That's shocking as well. So there hasn't been much of innovation to justify the multiples and the valuation of Apple, in my view. But again, that's not specifically on one company. I'm just trying to use Apple as a great example of the overall market. You could do this with Microsoft. You could do this with even Tesla as well and other companies. But the point being, when you extrapolate that even further and look at relative to the mining industry, now you're talking about 11 times an entire metals and mining industry. Apple is about 11 times the size of the overall industry. So, I think things are, very extreme right now and unlikely to be this in the next 5 to 10 years, in my view. Let's go to the next chart. Now, in the next chart, I'm showing another thing that people say, the same folks that used to tell me specifically. I remember you. They used to tell me, that gold would never do well. That gold is something of the past, and you're supposed to be looking at new assets and so forth. And the same people that also dismissed miners, and now miners, seniors are doing very well, are the same people that are now telling me that juniors and exploration stocks are dead. And I don't believe in that. I don't believe in that at all, because I believe in history. I believe in analysis. I don't believe in new theses that are not supported by real evidence of things. And what I find here is that the gold miners' free cash flow tends to have a very strong correlation with exploration stocks. And that's usually because as they start building more cash, you also tend to see these companies engage in M&A. And so it makes sense. They make more money. They need to grow. You have that pressure from shareholders. You got to, you speak with folks in the industry and they're still talking about large dividends and buybacks, and this conversation is going to change. Wake me up when all these mining companies stop paying dividends and actually start focusing on acquisitions. That's yet to come. And most of the acquisitions we've seen are happening across the big companies. It's very likely that we'll probably see the big companies starting to buy the smaller companies because they're cheaper, because they have better valuations, because they're also securing large deposits in some cases. And they are the ones that really answer the question that their shareholders could be concerned very soon, which is growth. And we know for a fact that a lot of the mining companies have been depleting their reserves and not improving their, not really improving the quality of their assets either. So that's a question to come, in my view, and not something that has structurally changed like most people tend to propose as an idea. It's just my 2 cents. Maybe they are right. I don't think this time is different. I'm a believer of history, and I also like to support that view by looking at evidence on the data as well. So here you see free cash flow surging recently, and you see exploration stocks is still lagging. And in my view, the lag is your friend. Let's go to the next chart. In the next chart, I'm looking at a relationship that I've noticed in the past, and now we're seeing this big divergence, which I think it's a very attractive opportunity in my view. And that's gold adjusted by inflation in yellow. And then you can see the blue line is silver alone. Okay, so inflation, let's get the elephant out of the room here, which is inflation. I'm calling CPI. I know a lot of people are going to hate me for this. It's just an easier name. If I say CPI, a lot of people don't, some folks don't even know what CPI is. I'm trying to simplify the chart. But you can see the idea here, though, that gold usually kind of follows, when adjusted by CPI, follows silver remarkably close. And if you see the separation recently between those two, it kind of gives you the idea that maybe the blue line has a lot to catch up on. And I suspect that we're getting very close to something very special on the silver side. Some people say, "Oh, you've been saying this for so long," and blah blah blah. Look, I'm a value investor at heart. If the thesis remains intact and the asset remains attractive, and prices won't bother me at all. We've engineered this whole acquisition of what it is now the 4th largest silver mine in the world, St. Cristobal. We did a leverage buyout with our clients and also partners of Crescat, and this has been one outstanding investment. And I think there's many opportunities in that front that provide that leverage to silver prices, of which I believe so much on the macro thesis for. So anyways, it's just a point to show how things can change very quickly on the blue line. Let's go to the next chart. On the next chart, we're looking at a relationship that often people don't talk about. The gold miners actually have a strong correlation with Japanese yen. If you notice that, well, that's remarkable. And that's usually because the Japanese yen and gold miners, what do they have in common? Well, it's the dollar cycle. The dollar cycle is usually aligned with the gold cycle. And that doesn't mean the dollar is going to lose its reserve currency status or anything along those lines. All I'm trying to say is that clearly when the miners have turned, you tend to see then a little bit of a delay, and then the yen tends to catch up to the yellow line. Notice what happened in the mid-2000s there. Mid-2000s, you can see clearly in this chart that gold miners in yellow were rising, and the blue line was not rising. It was actually diverging negatively and falling. And then we went on from, I think, 07 or 08, all the way down to 2011 or so, and one of the most aggressive appreciations for the Japanese yen versus the dollar that we've seen in history. I think we are likely to see something similar. Therefore, why I believe that I'm bullish other currencies. This is not a pick on yen specifically. It's a pick on other currencies relative to the dollar. I believe that we're about to see a big appreciation of those relative to the dollar in a large way. And I think the dollar cycle is turning. Let's go to the next chart. Why is the dollar cycle going to turn? Well, you can see in this chart, to me, is very clear. It goes back all the way to the 70s. We've seen a few of those in the past. And I think we're in the process of seeing another one. If you notice in this chart, not the very peak of the last, of that, but a little bit after that. You can see that it was really August of 2024 when on a 10-year rolling change basis, the DXY index has started to fall. And once we get into that, I mean, we haven't even seen that turn negative. Once that turns negative, we tend to see almost like a full decade of that declining. So the dollar cycles tend to be very long-term oriented. And I believe that's, we just entered another one, about a year ago. And I think this is at the very early stages of that. If you recall, wrote many letters about this. We wrote many letters about the bear case of the US dollar. And I think that's just the beginning. I don't think that's the end of it. So, it's something to pay attention to. Now, remember, dollar cycles are usually linked to gold. And there's a reason why dollar cycles are usually linked to emerging markets as well, and other currencies and other markets that are outside of the US. The main reason for that is because for the dollar to depreciate, usually you have two things happening. You have interest rate differentials changing. So in other words, today, the US economy is paying somewhere close to 4 to 5% of interest payments relative to GDP. Moody's came in and said, well, we're going to downgrade the US sovereignty and so forth. And everybody knows this. And they're not wrong. What they are saying is that if you look at all the comparative economies in the world that are similar to the size of the US, nobody is paying anywhere close to what the US is paying in terms of interest payments to GDP. Japan, for instance, is paying 0.9% or something. Europe, a few countries are close to it. The majority of them are way below 1 or 2%. So the U.S. is in a position where it has to cut rates almost, or otherwise, and as we know in markets, FX is a relative game. It's not about the U.S., you having a view about the U.S. cutting rates. You have to have a view about what's going to happen in the other side of the world as well. And in my opinion, given this sense of urgency from the U.S. economy to cut rates, it's been of my view that change of interest rate differential is likely to have an impact on the dollar turn. And when you think about this, and you have the two factors that are most important in the market to think about when you're investing in emerging markets, is usually a strong dollar, and a rising interest rate environment is a no-go. You don't want to invest in emerging markets in those environments. I believe we're going to see an environment where rates might be suppressed and the dollar may actually be in a downward trend. Well, that's a green light for emerging markets in my book. So these are just the way I'm, thinking about these things. But this chart is, to me, a great way of presenting that case in terms of the turning point of the dollar, of which was maybe 8-9 months ago. But remember, once we turn negative, it's just the beginning. There's still, most likely another decade or 5 to 10 years of a very significant declines on the 10-year rolling change. Let's go to the next chart. I'm almost done. Canadian dollar is a great example. I think Paul Tudor Jones said once, a lot of people like to look for breakouts and say, "Whoa, breakout! Now I'm going to, start investing in this asset." But what he said is that the real money is made when you are part of the breakout. And I look at this chart, and if there is a breakout, everyone would be saying, "Well, that was obvious." Yeah, nobody is seeing this as obvious now. In fact, we went to a presentation not too long ago in Switzerland. I was participating in a conference, and there was a panel discussion, and maybe 300 people sitting there in this event. And I asked the question, how many people, raise your hand, how many people think that the Canadian dollar will rally against the US dollar in the next 12 months? Do you know how many people raised their hand? None. Actually, I should say the guy on my side, which was Ronnie Sterfole from Increment and AG, because we were talking about this before, and we were just sharing ideas. I thought that was shocking. That was really shocking to me, because obviously I had a view about the Canadian dollar, and I just wanted to sense a little bit of the sentiment. And Canadian dollar is having a great year to date. If you look at this chart, it's a very long-term chart. So this little small appreciation that we've had recently is already there in this year. But I think it's just the beginning. I think we're going to see a lot more of that. And that's because if you want to fix the trade balance issue, you don't fix the trade balance issue with a strong dollar. I've never seen that happen before. So Again, I'm using history on my side on this, and this is why what gives me conviction. And by no means I have a crystal ball on this. I'm just sharing you my views. Let's go to the next chart. Next chart is something that, if you show the white line, I've done this many times, so you're welcome to learn from my mistakes. And if you look at the white line in this chart, which is commodities to equity ratio, and you go, create a Twitter or X account and post this chart, you know what people are going to tell you? Yeah, you could have posted this 10 years ago and the chart would have been in the same place. Do you know what's different this time here? Or I shouldn't say that because it's not different this time. The chart clearly has a cycle that changes over history. But you know what's different about the prior times you could have posted this chart is that the dollar is turning. And the dollar turning, as you can see, which is the blue line in this chart, is usually what it almost perfectly times the rise in the white line, of which is when hard assets begin to outperform financial assets. That's what this chart is about, is gold, energy commodities, is silver, metals, copper, all those things really outperforming the market, the equity market, the S&P 500, NASDAQ, the technology stocks. And I think that, more and more, if you notice on your days, today, again, being one example, of course, you can see today, again, that you have overall markets down, hard assets are rallying. And guess what's the third thing happening? US dollars falling as well. And I don't think these things are a fluke. I think these things are happening more and more for a reason. And I think we're going to see more of that, not less, because of this chart. I think that these two lines are about to converge just like they've done it in the past. And so this is why I'm paying close attention to this. Let's go to the next chart now, if you don't mind. And this chart, now you're looking at something that, some folks have realized that I'm in a empty shelf behind me. And that I moved, I moved part of the year, not entire year. Part of the year, I intend to live in Brazil. And that's because I just had to move here a week ago. And so a week and a half ago. And, the reason for it is because, one, I believe in the country. I think the country is going to do great. I think that we're going to see big political changes ahead. I think things are really cheap. It's one of the few markets that I know where real estate is down over 55%. I like something cheap. And so it caught my attention. Obviously, I have family here, so it's a lot easier for me to make a change. But also, I think that the leadership in markets it changes over history. Clearly, as you can see in this chart that is on the screen, in some periods you have U.S. equities outperforming Latin America stocks. Some others you have the other way around. And we've been through the longest period in history, probably, that U.S. equities have outperformed Latin American equities. And so I'm of the belief we're going to see the opposite in the next 10 years. And so usually that tends to have an impact in the economy. That tends to have an impact in equity markets in those domestic economies. And I think Latin America is likely to be one of the best regions to invest in the next 10 years. And so this is my case for it in 2 minutes. I think this is my last chart. Just want to prove that, if that's all right. Oh, no, I have one more. This chart is interesting as well. If you notice in this chart, you take a close look, you're going to find a few things. Number one, less than 1% of people are investing in commodities. Well, that's a little bit shocking given all I said about energy, electricity, consumption potentially could surge. Who knows? I don't think that justifies a 1% allocation in my strategic way of thinking of how to invest. Number two, you notice that gold and precious metals are 2% of their holdings. And that to me is also shocking. And thirdly, is emerging markets is about 1%. So I don't know, folks. I personally, I think that is, I find it actually interesting. They call this strategic asset allocation. The word strategic to me it couldn't be less of an strategic thinking than this. But, I think this is the sort of the function of where capital has found itself in the last 10 years. And people tend to think and extrapolate that these things will keep going in the following decade. And usually leadership changes and asset performances changes as well over time. And you have to continue to be innovating your views about things. And I think that people are stuck in the last 10 years in these types of allocations. But that's just my view, and I believe that a lot of other things will be different in this following decade. Let's go to the next chart because I think that's it. Oh no, that's one more thinking, because I did have questions about one from folks asking me about the 30-year yield in Japan has been moving higher, and I've people asking me what is your views on that. And look, I'm just going to share this because I think I have a unique perspective on this, and that's just because I think there's a lot of negotiations happening between U.S. and Japan right now, and if you look at the ownership of the JGBs, about 50% is owned by the Bank of Japan. And so who is selling this is a big question, right? Obviously, it's, or maybe not obviously. I mean, it's a much smaller group, who knows? And for the BOJ to step in and start buying assets again, it's not a huge ask, right? I mean, they've done it in the past, they can do it again. To me, it seems like this is almost like you're letting that happen. And the main reason for it is because, when you look at the duration of the debt in Japan, mostly is 10-year below. And so, in fact, the average duration of the debt is about 9 years. And so when you think about this from a practical standpoint, the 30-year yield rising, it doesn't have a direct impact necessarily on ballooning the debt even further. And so, the real concern to me is not even the Japanese yield rise. It really is the U.S. The fact that the entire curve has moved a lot higher, and we're now seeing rates in the U.S. higher than even when Janet Yellen was the Treasury Secretary, and Biden was in the administration, which is crazy. And what we're seeing here in terms of that front is to me, that's a real threat, because the U.S. doesn't have the luxury at all to let rates move to this degree. If I had a gun in my hand to choose who is closer to getting some sort of yield curve control mechanism to control or manipulate the interest rates, I think the U.S. is closer than Japan. So a few things. The dollar carry trade, the reversal dollar carry trade idea is very possible, and it's that's rising. And I feel like part of this negotiation, by allowing Japan to let the 30-year and the 10-year actually rise, would make Japanese yen a lot more attractive and Japanese assets more attractive as well, and creating a rally on the Japanese yen alone relative to the dollar, of which fixes a lot of issues. If you think about, the U.S. and Japan have a pretty significant surplus, of which Japan is running a surplus on the trade balance. And how do you fix that? Well, one way to fix that is you fix your auto industry in the U.S., because that's a huge part of what we import from Japan. Number two, you can also improve the dollar situation. You devalue the dollar, you allow the Japanese yen to be stronger. And how do you do that? Well, you change the interest rate differential. You allow the interest rates in Japan to rise relative to the U.S. So when people ask me what's more relevant here, I actually think it's that the U.S. has to follow Japan and start doing more yield curve control that they did not too long ago, and they're probably going to have to do it. And this chart that you're looking at the screen goes to show that we have not seen any of that yet. I mean, just look at the BOJ, assets relative to GDP today are over 124%, and the Fed is about 22%. So I think that's very likely to change in the U.S. front, and we're probably going to see much higher levels there.